Now in Unit 5.3, we're going to discuss the term structure of interest rates. The term structure of interest rate tells us the relationship between bond yields and maturity. And it is important to study this structure, especially for corporate treasurers, because they need to decide whether they should issue long-term or short-term bond, which is the best avenue to borrow money. Similarly, your investor needs to make the same decision that where should they invest their money. So both borrowers and lenders should understand, number one, how long and short-term rates relate to each other and what causes the shifts in the relative level. Over here, now we're going to look at some yield curves. So yield curve is a graph that shows a relationship between bond yields and maturity. You can see over here that there are three yield curves. One is for March 1980, then one is for February, and the other one is January 2008. They are for different months and different years. On the horizontal axis, you have the years to maturity. So till here it is short term, then you are talking about intermediate bonds, and a maturity of 10 years, more than 10 years is considered to be a long-term bond. Then over here you have the interest rates. Now you can see that the shape of the graph is different in each and every case. So there can be multiple shapes in yield curve, but we will be discussing the most common three. So the first one, you can see that it is going like this. So it is actually downward sloping. Okay, so a downward sloping yield curve is going to occur when the short-term rates are going to be higher than the long-term rates. So in this scenario, the short-term rates are higher than the long-term rates. Then this one, if you can see, so it's increasing a bit over here and then it's going downward. So this one is called a humped yield curve. In a humped yield curve, actually the intermediate term bonds have a higher interest rate than both the short-term and the long-term interest rates. So this is going to happen when the medium rates are higher. And then lastly, you can see that this is going upwards. So this is your upward sloping yield curve. And your upward sloping yield curve will happen when the long-term bonds have a higher interest rate than both the intermediate and the short-term bonds. So over here, the highest rate will be of the long-term bonds. And you have already studied the maturity risk premium. So you know that bonds that have a higher maturity, they have more interest rate risk, due to which they have more maturity risk premium. So actually the upward sloping curve is the normal yield curve. And the other curves are usually called the abnormal curves, because the short-term rates ideally should not have a higher rate. Neither should the intermediate ones have a higher interest rate than the long-term bonds. But this does happen depending upon what is the economic situation, and we will study later on that what determines the shape of these yield curves. So what determines the shape of the yield curve? We have already studied different shapes, and the primary reason that there are different shapes is because of the inflation premium. Now, in order to understand how does the inflation premium impact our yield curve, we're going to take the example of government bonds, because they do not have any liquidity premium, neither do they have any default premium. So it's going to be simpler if we discuss it with less amount of risks. Now over here you can see that there are two types of graphs. When inflation is expected to increase, you have an upward sloping curve, and when inflation is expected to decrease, you have a downward sloping curve. On the horizontal axis, we have the years to maturity, and on the vertical axis, we have the interest rate. The real risk-free rate is the same for both cases. It's 2.5%. Now let's first discuss when inflation is expected to increase. Now remember that the inflation premium is the average level of expected inflation over the life of the bond. That means that if you have a 10-year bond and you have, let's say, a 2-year bond, and if the expected inflation is that over the 10 years in the future, the inflation rate is going to be very high. So if inflation is going to be high, then automatically the inflation premium on the 10-year bond is going to be more than the 2-year bond, because of the fact that it is the expected inflation during the whole 10 years. And it is expected that inflation will be more in the coming years than the current year. So that means that their inflation premium is going to increase with the maturity of the bond. And you can see that the maturity risk premiums over here, the gap is less and it is increasing. So the maturity risk premium, like we have already discussed, will increase with the maturity time of the bond because of the interest rate risk, because the longer term bond has a higher amount of interest rate risk. If the interest rate increases, then the bond price is going to decrease a lot for the longer term bonds. That means the interest rate risk is going to be high, the maturity risk premium is going to be higher than the short term bond. Now let's look at the other scenario when inflation is expected to decrease. So it is expected now that the inflation is going to go down, and currently the inflation is actually more. That would mean that the inflation premium on the 2-year bond is going to be higher now than this one, because the expectation is that it will go down, then automatically the inflation premium is going to go down, which is what is happening over here. So over here you can see that the inflation premium was this much, and with time it is declining as the maturity is increasing, and for the 30-year bond it is lesser, because it is expected that in the future the inflation is going to go down. But over here you can see that the maturity risk premium is still increasing, so that is still not going to change. The maturity risk premium is still higher for the longer duration bonds, but the curve itself is different now because of the inflation premium factor. Now it is also important to note over here that this kind of a graph is going to occur most probably when your economy is in a downturn, which means when your economy is in a recession, because that is usually when the prices tend to go down and when inflation decreases. Whereas this is going to happen most probably when the economy is expanding and everything is going well. So previously we discussed the yield curve by taking the example of government bonds. Similarly will be the case for corporate bonds as well. So depending upon the inflation premium, the shape of the curve will be determined. However, your corporate bond yields will be greater than your treasury bond yields, as you can see it over here. This is a double A rated bond. It's a corporate bond and it has a higher yield than the treasury bond. It's following the same shape, but it is going to be higher. Similarly, the triple B rated bond is going to offer an even more higher rate because it has gotten a lower rating. It means that the default risk for this one is higher. And the reason for this upward shift is because your corporate bond will include the default risk as well and the liquidity premium as well. So the default risk premium is going to depend upon the rating of the bond. So the AA is actually better than the triple B. The AA has a lower chance of defaulting. That's why it has a lower yield than your triple B. But you can see that it is still greater than the treasury bond because your government bonds are considered to be default free. Now the default risk premium is going to be higher for longer term bonds, as you can see over here. As the years to maturity are increasing, so is the yield increasing. One of the reasons for this is because the higher bonds will have a higher default risk premium as well, because if you're buying a 50 years bond, for example, there are more chances that the corporation might default by that time. And if you purchase a 2 years bond, so you're taking a lesser chance of default in that case. You can more easily predict what will happen in the corporation over the 2 years and what will happen over the next 50 years. Similarly, the liquidity premium will also increase as the maturity time period increases. So the longer duration bond that you purchase, the lesser will be the liquidity of that bond. And the shorter maturity bond that you purchase will be more liquid. Now, in the last section, we have seen that the slope of the yield curve depends primarily on two factors. Number one is the inflation premium, and the second factor is the effect of maturity on the bond's risks. And we also saw that how to calculate the yield curve given the inflation and maturity related risks. Note now that people can actually reverse this process. So they can look at the yield curve and use this information embedded in it to estimate the market's expectation regarding what is going to be the future inflation and the future interest rates. For example, suppose that a company is in the midst of a 5-year expansion program and the treasurer knows that she will need to borrow short-term funds a year from now. She knows the current cost of the 1-year money, but she wants to know the cost of the 1-year money that will be available next year. This information can actually be backed out by analyzing the current yield curve. And how is that possible? Because it is based on the pure expectation theory, which assumes that bond traders establish bond prices and interest rates strictly on the basis of expectations for future interest rates, and they are indifferent to maturity because they do not view long-term bonds as being riskier than short-term bonds. Basically, in the pure expectation theory, you assume that the maturity risk premium does not exist. It is zero. And there is no difference whether you're investing in the long-term bond or the short-term bond. If that is the case, then your long-term rates would simply be a weighted average of the current and expected future short-term interest rates, and you can derive out the value. So this is an assumption that this theory takes. And after assuming that the market risk premium is zero, you can work out what is going to be the future interest rate. Let's look at an example of how this is done. So now assume that a 1-year treasury bond currently yields 5%, while a 2-year bond yields 5.5%. Investors who want to invest for a 2-year horizon have now two primary options. Option number one is that they can buy the 2-year security and hold it for 2 years. And the second option is that they can buy the 1-year security and hold it for 1 year and then reinvest the proceeds in another 1-year security. Both should actually give the same return because the horizon is the same, the investment time period is the same. So let me now show you the calculations that how can we derive the next year rate. So option number one is that funds will be invested for 2 years at that rate. So if we need to figure out the funds at the end of year 2, you can calculate that by using the future value formula. So you should remember this formula. You must have studied this in Principles of Finance. So let's assume that $1 is being invested. So $1 is the present value and it will be invested at the 5.5% rate. Okay, this was the rate for the 2 years. And this is invested for 2 complete years. So this will give you 1.113025. Now, even if I select option 2, which is to invest in the 1-year rate, get the proceeds, and then reinvest it again at the rate, they should still get the same return. That means that if they go for option 2, funds at the end of year 2 should be the same. But now you're going to invest that one first for 1 year only at the 5% rate. And then whatever are the proceeds, you will reinvest them back at whatever is the rate 1 year later, which you do not know. So this is the missing figure that you want to figure out. And you already know that the proceeds should be this much at the end of year 2. This also has power 1, okay? Now let's just solve this. Now this is multiplying over here. So on that side, it will go into division. And now you can shift the 1 on the other side as well. So if you solve this, you should get the x value, which is 0.0600238. So this means you can convert it into a percentage, which means multiply it by 106.00238%. This is the rate 1 year later. So for 1 year, after 1 year, it is expected that the treasurer can get a 1-year loan at this interest rate. You have derived this out. Okay, so 1-year rate 1 year from today must be this much, that one we have calculated. And if that it is not the case, and in reality the rate is different, then one option will be better than the other, and the market will actually not be in equilibrium. So what will happen if that is the case and the market is not in equilibrium? So if the market is not in equilibrium, buying and selling will happen in the market, and the market will go back to its equilibrium level. For example, assume that the 2-year bond now actually yields 5.25%. So the investors can now actually make an arbitrage strategy from this, which is basically riskless profit. What they can do is that they can borrow at the lower 5.25% rate, and they can lend money at first the 5% rate for 1 year, and then the proceeds in the 6.00238% rate for another 1 year. This will actually give them a return of 5.5%. So they'll borrow at a lower rate and they'll lend at a higher rate. But other people will also figure this out, and because of that, there will be a supply increase over here, and because the supply will increase, the interest rate will automatically go down and will become equal to 5.25% as well.